to Freightonomics, the podcast / show, depending on how you view it or listen to it, where we discuss the freight market and the macroeconomic environment. We put those two things together because they're very connected, Anthony Smith.
They are.
They are. And
Just
I
like
am.
You and me, we're friends, right?
We're friends. While we're here, but when the cameras go off, like, we don't talk to each other. We just walk our separate ways and never interact. No, that's not true. We were just talking about a fun little tidbit about how our spending habits change over time as you get older, and it has a huge influence on the economy, how people change their spending habits and behaviors, and especially as the economy is transitioning.
Yeah, and I think when you get older, some of the things I've realized I enjoyed now in my later years is paying more for convenience. And I think when you start getting a little bit more income, you start paying a little bit more for convenience. In some cases, sometimes you're able to just kind of like, you know what, no, this is my budget, this will be my budget, this will stay my budget. But I think the American economy is very much similar to that when we're looking at things like convenience for next day delivery or e-commerce trends or anything like that, or drive-through, anything like that that's a convenience. We want to maintain that balance for that convenience going forward. Yeah,
you don't want to let go of the convenience. Once you've been able to kind of afford the convenience, it's not something you transition back into easily, at least willingly. And I think that's something that's a big question about the holiday season, this upcoming holiday season. We're obviously in a downturn of the economy. I don't know if anybody's arguing. It may not be fully recognized or manifested yet, which is probably the most concerning aspect of all these things. But we're still going through this cycle. Inflation obviously eroding a lot of people's incomes. We had Bank of America spending data come out earlier this week that suggested that consumers are simply not spending the same amount of money on durable goods that they were a year ago. I don't think this is something that is super surprising, right?
Yeah, it's not too surprising at all. And I think, so beginning of this year, we're talking about what's likely going to happen and our expectations for timings around when consumers are going to start to feel that pain. I think they are certainly feeling it now, especially with inflationary pressures. Last Friday, we just got an update around the credit card report as well for the monthly updates, and we saw that credit card spending is indeed going up when you look at credit card utilization on a revolving basis. And Zach, you're seeing
they're carrying more debt.
They're carrying more debt, acquiring more debt, and you're also seeing that the savings rate is still below the pandemic level, pre-pandemic level, and it's not shaping up to be an incredible growth structure for the remainder of the year going into 2023.
Yeah, and I think that's the theme of today, abruptly lagging. we look at some of these indicators. It takes a long time for them to really get flushed out, especially when you're transitioning from a period, an economic cycle, if you will, that has been so robust. We had so much money flooding the space, consumer demand growth, infrastructure growth, super high levels of growth. This is why the Fed targets, sub 4% growth rates, because you run the risk of inflating these bubbles in the market. There's bubbles everywhere right now that are starting to fall apart a little bit. Housing market, not necessarily popping or bursting just yet, but it is showing signs of deterioration all over the place. The freight market, of course, has been a leading indicator of all this. And for those of you that have been watching over the last month and a half, I like to give a little market in two update to kick things off because the freight market does continue to transition. Anthony, do you want to count me in?
I'm going to count you in, Zach. Now, there's like this internal emoji that's going around with like me shaking my head really fast, and sometimes I try to replicate it, and I can't do it, but I was going to try to do it just now. That's why I mentioned. But anyway, counting down in 3, 2, 1, let's go.
Let's open up with the NTI, the National Truckload Index, measures spot rates on average based on our Trusted Rate Assessment Consortium. So we're looking at a pretty flat movement here, but a downward trend versus last week. We talked about the end of quarter, end of month. The green line is removing fuel entirely. The white line has fuel completely baked in. We do that because the green line shows us the market trends itself, removing the fuel fluctuations. So We saw a little bit of a bump at the end of September, end of quarter, end of month. Also Hurricane Ian, we saw some spot rates increasing into the Florida market down there. So that is looking like it is coming down. We talked about it being very transitory and do not rely on it because the underlying demand side indicators are not there. And then let's move to the next chart here. Look at our tender rejection index, our OTRI, if you will. Tender rejection rates, they did not budge during this end of month period. This is something they've been very unresponsive towards the holiday periods, as well as some of these, near-term market disruptions such as the rail strike, as well as Hurricane Ian. Didn't budge there, and they are right in line with that orange line there, which is 2019 levels, which we all remember is a very deflationary rate environment. Let's move to the next chart and talk about some of that demand side indicator, CLAV. Looking at our contract load accepted volumes. These are the accepted load volumes in an index. And you look at the previous 2 years there, 2020 and 2021 in blue and green lines respectively, we are now transitioning much lower. That downward trend, Anthony Smith, is really the sign that I'm watching to. We see the seasonal deflation in volume and activity in early October, but the last 2 years, it flatlined out. And that is the concerning part, is that it looks like it's probably going to continue, which is going to further erode the rates. Let's look at our last chart here real quick, because contract versus spot rates. We see contracts still have a lot of downward pressure on them as they are still well above the spot.
Impressive, Zach, once again. So diving into this, when we're looking at those seasonal trends, it's starting to look more closely aligned to 2019 in some aspects.
Yeah, and I think the big takeaway for me is that's not a surprise.
Yeah.
We're still, if you looked at the CLAV there, it's still well above where it was in 2019. So we're still seeing a lot of demand. The big question about that chart is, how far will it go? We've had growth in capacity, infrastructure growth like we just talked about over the last 2 years. These transportation providers have grown accustomed to a heightened level of demand,
right,
and they had to adjust to it. Like, the market environment had to adjust. The question I have moving forward is, how deflationary does this get? Because there's not enough pie to go around anymore.
Yeah, that's a big part. And this kind of also goes into the driver situation, because of course, when we also think about, okay, there's a driver shortage, it's hard to argue about a driver shortage when you're starting to see where we have our tender rejection index is looking at right now. And we're seeing that the capacity is really abundant at this moment. And we're also seeing that transportation prices are starting to come down, especially as you just had on there on that spot rate.
Yeah, tender rejection rates now at multi-year lows. We're right in line with where we were in 2019.
Yeah.
Just below 5%. We hadn't been below 5%. And if you had talked about this index being below 5% last year, you would have thought that the world had ended.
Yeah.
We were above 20% for 2 years. 2 years we were above 20%. And 1 out of every 5 loads. Now we're looking at 1 out of every 20 loads getting rejected, or less than that. And that's, still, these contract rates are still elevated. You saw the last chart.
Yeah.
Contract rates still well above where they were 2 years ago, also well above the spot market, which is offering a significant discount. If we want to pull that chart up real quick, let's do the contract versus spot. So the white line is the contract, van contract rates, initial report. You can see there's been some stair steps here. They started to, it looked like things were going to change dramatically.
Yeah.
In August. We took a huge stair step down. September, not so much. It was like a 2% drop in September for contract rates. A lot of questions around how sticky are these contract rates going to be. But looking at the spot market and that green line, removing fuel to an extent, there is so much downward pressure. Like, I don't think these contracts cannot sustain at this level above spot market when somebody can simply go out and say, hey, I'm going to go get this. I think service is going to be a big selling factor here. If your contract provider, if you're a shipper out there, is giving you good service, I think you've grown accustomed to bad service.
Right.
So just not having to go through the managerial process of trying to source carriers right now is probably going to help keep contracts up a little bit, but you can't sustain that kind of spread.
And that's where we always hear, one of the big things I always hear from people that interview on Freightways Now or any kind of show like that. It's about relationships, and I think this is kind of where it kind of ties back into is like, hey, we got to build strong relationships in good times and bad times, but really money talks. And when you have spot rates that low, there's only so much a relationship can do for you.
Yeah, and I want to tie this into inflation, because this is the way that spot rates and trucking work with contract rates are a lot like what we're dealing with the Fed rate increases. The idea is that they are trying to erode demand to a point that you have these, it's almost, I wouldn't say deflationary, but you have this correction to where you're not seeing as much, demand outpacing supply, to where you can't, sustain that price level.
Right.
We're seeing deflationary pressure in trucking and transportation costs right now. The spot market adjusted a long time ago. In March, the spot rates fell out 30% almost overnight, with this like a 6-week period. And it takes a long time for that to manifest on the long-term side. And that's kind of the argument that's going on right now with the Fed. And you're not going to see all of a sudden everybody stop buying stuff with a 75 basis point increase in the rate increase.
Yeah.
That is a near-term rate that the banks feel quickly, but the consumers don't feel that till months later.
Yeah, consumers are going to feel that months later. And one of the big things about it is like, when you look at consumer sentiment, and this was an index that I was really big on, say, 2019 going into 2020, I was all about, hey, how are the consumers feeling? It matters eventually. And then I kind of slowed down on it, because I started looking at consumer conditions and really what consumers care about. Do they have a job? And how expensive is it to live? Because if gas is too high, this economy sucks, essentially is what the consumers are saying. And so now we're seeing, of course, consumers being hit by inflation. And we're still seeing that a lot of people are thinking that, we're still going to be on par for a soft landing potentially. But I think that idea is really starting to kind of get a little bit more and more dim. But one of the other big aspects that we have to think about is like, hey, this isn't a slowing economy right now, with an unemployment rate at, sub 4%, with still 10.1 million job openings right now. This goes down, and layoffs go up, which they will continue to trend upwards, and their jobs claims will continue to trend upwards overall. It's not going to be a pretty picture as we get into the new year.
Well, we've seen this time and time again. There's certain indicators that we look at, especially on our end, high frequency, near term. It's very responsive data. It doesn't necessarily mean that we're in a recession the day that it falls. Our outbound tender volume index dropped. Our IOTI that measures maritime dropped significantly, but the wind isn't taken out of the sails all at once.
Right.
This is just significant signs that things have changed dramatically, and you have to take those signs as for what they are, which are signs that things are changing, they are shifting, and you respond to those things because you now have a near-term signal. If you look at some of these longer reaching, slower data points, such as employment levels, it takes a while. Think about what goes into an employment, the idea that you are going to put a job out there. That takes months.
There's a significant lag there.
There's months-long process. Anybody in human resources, talk to us. How long does it take for you to say, I'm going to put out a job rec into a space that somebody has said, hey, I need to hire another person?
Yeah.
That's not something that you do like overnight.
And another big aspect of it with those job openings, there's so many times where you have a job opening posted and you're not really that motivated to fill that role.
Right.
So there's been, many companies that are guilty of this, of like, hey, we're hiring for this, and this, but not really so much. And so we're looking at 10.1 million job openings. I don't think a lot of these companies are really actually hiring for this, even though
they can leave it out there. There's no consequence for you keeping a job rec out there and open. And in the meantime, you're busy with your day-to-day.
Yeah.
So jobs are very slow, and it's one of the pivotal factors that the Fed leans on to make these decisions. And I think that that's a bad move. In what I would think a normal environment, which we are not in, we're coming out of a very volatile period of time with rapidly changing indicators. That's where you have to be more disciplined. In my point of view, you have to take it. The market's going to change on its own.
Yeah.
You're not controlling every lever in the economy. You have one lever you can pull, and it takes time for it to manifest. All these other levers, you have to understand what they're telling you. And the jobs market is extremely slow. Doesn't tell you what did we do? 3.5% unemployment rate. What would you say to that?
Well, first I would say, hey, the participation rate is still below where it was. So you have this, matching, near record low unemployment rate, but fewer workers. Then I would also look at the job openings number, and then I would also kind of put it all together and say it seems as though we have more people working fewer jobs. And so this almost seems like, hey, there are more people taking on part-time jobs, multiple full-time jobs potentially, or you're doing that quiet quitting thing or whatever it might be, and do 2 full-time roles in a 30-hour work week or something like that. But in order to keep up with the rate of inflation, because you have some people getting part-time jobs, hey, I need a little bit more because I can't keep up with my expenses.
Yeah, and we're in a country that just came out of an economic boom. So people have money.
Yeah.
Like companies have money. And so it's going to take a while to get through that money to where you start realizing, hey, I don't have money anymore. Yeah. We're starting to see that show up. So I want to go into our news and nomics because I think we have a good, we got peak season coming up, and we've got Brian Strait writing this article that I think is very timely, covering consumer sentiment, something you specialize in. So this is pretty eye-opening to me because it's a survey of more than 8,000 consumers and 800 merchants in 8 countries found that holiday shopping will be muted this year, with as much as $46 billion in total being cut from spending budgets. Now, my big takeaway here, and this was, I should say, the Holiday Shopping Trends Report conducted by Octane and Retail Economics for ShipStation is where this comes from. And the big takeaway for me is not necessarily that we expect a muted holiday season, it's the discrepancy between the shipper and the consumer. Shippers are far more optimistic about consumer behavior, whereas the consumers are saying, effectively, like, we expect to pull back. 58% of consumers, of U.S. consumers, expect to cut back on non-food spending this holiday season. And that's not being reflected in the shippers' responses to this.
And I think a lot of shippers we talked about this, a few times, putting on that brave face, especially when quarterly calls, things like that, and saying, hey, we are, the economy's slowing, but we're doing just fine. So I think there's a little bit of that mixed in there. And I think there's this other aspect from really large shippers where they're positioning themselves potentially as like saying, hey, if I mark these down low enough, they will sell. Yeah. We will push units. And I think that's going to be a tactic for a lot of folks. But I think that tactic will probably start to hurt a lot of other businesses because now their margins are just completely, trash. And they're not pulling in the same type of revenue. They're kind of riding that pandemic revenue wave that they had from the last couple of years. And I think a lot of manufacturers upstream pulling in a lot of capital good orders because they have the cash on hand, want to avoid higher levels of interest rates and if they're acquiring it on credit. Yeah,
they're slow to recognize what's happening. The consumers are front line.
Yeah.
The shippers are second line. The manufacturers are even further back. Yeah. So there's a wave of recognition of what's happening. Anybody on the front line, near term, understands what's happening in the moment. You get in that second, third tier of activity, you're lagging. You don't know because you're not in the day-to-day. It's like, if you're in a company, you're a frontline broker.
Yeah.
You're going to know what's happening quicker than your managers. And that's simply because you're in it day-to-day and you feel it. Whereas the managers hear it in a weekly report, they're going to feel it pretty quick. And then it's going to go work its way up. And then that's when you get that long level or that long-term strategery, if you will. One of the sectors that was called out here, the automotive sector, is actually not feeling as much of the initial direct hit as some of the retail sector is. And Noy Mahoney writes this article, Mexico replaces Canada as top U.S. trade partner last month. This is a fantastic article. It's very short, very concise, but it tells a lot of information. Mexico ranked as United States' top trading partner in August, accounting for $70.3 billion in cross-border commerce. Port Laredo's total trade with the world increased 29% year over year. This is a big deal, and everybody's going to scream nearshore, 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 friendshore, etc. Not so fast, my friends. Port Laredo's top 3 imports included motor vehicle parts, passenger vehicles, and heavy-duty trucks. All automotive focused. This is a catch-up. That pent-up demand. We talked about Class 8 orders for trucks last month, blowing the roof off, all-time high. in preliminary ACT reports, this is a catch-up. Yeah. This is not a, everybody's been sitting on old equipment, old cars, old vehicles, and now they're like, oh, I don't want to spend any more on maintenance. I'm sick of the parts not being here. It's costing me more than ever to just maintain these things. They're going out and getting new stuff. So there's a little bit of a lag, even though it's coming.
yeah, it's coming. And I mean, this is anecdotal, very much anecdotal, because I have an old 2006 Audi TT. And it's not doing the best right now. And so I like to go take it into the shop. The shop actually stopped servicing them. There's like, hey, it's taking too long to get parts over here. We no longer actually service this car anymore. So take it somewhere else. And this is like a car repair shop that specializes in Audis. And so this is going to be some of the pressure that some folks are like, you know what, I might as well just be better off buying a new car or buying a different used car. And like you said, there's been this catch-up being put into play because there was this lack of inventory. Now this inventory is starting to kind of start to be fulfilled, and this is definitely going to be an area that's going to be impacted as we continue to see slower consumer demand and increase in catch-up from the macro side or the industrial side.
Yeah, and the industrial side's huge.
Yeah.
These automotive parts, OEMs, big equipment, that takes a long time to manifest and go through cycles. The bigger, you used to play football, defensive linemen, how quick were they in response to the smaller corners?
Yeah, no. I could chase them down in a straight line, but you start talking about side-to-side movement, that's a whole nother adjustment.
That's a great point. Side-to-side movement, flexibility. You can adjust your course smaller. These big entities take a long time to go through their processes. We were talking about FedEx this morning, dealing with their issues. They're a huge company. Huge companies take a long time to pivot, whereas these smaller, flexible entities, they can transition pretty quick. Also in the news, and this again, it's kind of like further bad news. I hate to say it, but Morgan Stanley says jaw-dropping inventory levels a key risk to retailers. These companies, we just talked about it. Rachel Premack writes this piece, fantastic writer. Please read her stuff. It is phenomenal. They were trying to pivot, but they can't do it quickly. So what they have to do is move large. They're so big. An order to them isn't like you and I going out to the store and getting a piece of, bread or something like that. They have to buy everything in large pieces. Yeah. So these inventory levels that we're dealing with right now, they're huge, and it's high cost. And now it's inflated. The next article here, warehouse rents near cargo airports skyrocket, report says.
Yeah.
Huge pieces, huge movements from these large entities moving through the economic situation here in the United States are creating these huge pockets. And it's going to take time for them to, I guess, fully manifest macroeconomically, correct?
Yeah, and I mean, this is going to be one of those areas, of course, we got to get Dr. Zach Rogers on here.
We got to get him out here.
Back That's again for this next episode here. And I think he's going to be able to fit into our Thursday schedules before because it was school and he had a job and stuff like that. But one of the big areas that we saw is that inventory levels are continuing to go up. We're still seeing increasing costs for warehouse prices, and capacity is still low. And so this is going to be one of those areas where even, in the LMI report is showing that there's an expectation that this is going to likely persist as we continue to move forward.
Yeah, one of the call-outs in Rachel's article here, 19% discrepancy between inventory and sales growth. So they got a bunch of stuff that they can't sell. Yeah. They're looking to discount a lot of things. That's going to be a headwind for discount retailers like TJ Maxx, Marshalls. They call out a few of those in here. And she calls out automotive as also getting a little bit of that. They're kind of an outlier right now in the way they have they're getting inventory in now that's still kind of on par with demand.
Yeah.
And it's keeping inflation higher for that sector, which again, huge part. And is this true? 80% of core inflation related to automotive?
Like overall inflation in the U.S.?
It said 80% of core goods inflation.
I got a little bit of research about that.
I was like, that's scary because, again, lagging automotive industry, getting overly represented in our goods economy, which, again, they're a big part of it. Another big takeaway from this, the other warehouse article, there's no space. There is no space for any of these goods. I think Inland Empire has a vacancy rate, according to the Cushman and Wakefield, of less than 1%. Less than 1%. If we want to pull up that chart real quick, that graphic, to show just how bad it is overall, there's no warehouse space. It's inflating the cost of goods because you have to spend more in some of these key markets. Even in some of the smaller markets, we're seeing cost per square foot just skyrocket right now.
And Zach, that takes us to the tail end of this show. And it's not going to be the end of Freight Waves TV because we have tons more content coming on today. So if you're watching on LinkedIn, thank you so much. We appreciate it. But head over to tv.freightwaves.com where you can get a full rundown of our around-the-clock TV coverage and shows and all your favorite episodes. You can watch all the other older episodes of Freightonomics if you like.
I mean, that's what you should do with your time and energy. Certainly, maybe start thinking about saving money, but the savings account rate, they're not going up either.
No, they're not going up either. And
you know why? Because it takes a long time for those deposits that we had during the pandemic to ease out. Yeah. Lagging. There we go.
Look, Anthony agrees. Anthony agrees.